So your exam will be 5 questions. Now, these 5 questions will be, as you are aware, will be completed, all of them, in 3 hours. And it will have both theory of taxation and computation. And usually as a first class, I challenge students to do a simple assignment. So later, download the last setting or the last 3 settings and make a little research. Find out what was the awarding of marks. For example, what was the total marks awarded to theory only? What was the total marks awarded to computation? Try that assignment. Okay? What you'll find is the following. What you'll find in most sittings, you'll be surprised that the weight given to theory was more than computation. Probably you can find 55% of the paper was theory and 45% was computation, or sometimes it even goes higher, and so on. I want you to try that fascinating experiment. And there's a reason behind me saying that. The reason is this. The reason why I've challenged you to do that little exercise is to have a mind shift. You know, what we call a paradigm shift. You might be of the opinion that tax is a computational subject. So that would be very unfortunate because you'll only be working for 45%. Because in a setting where computations are only 45%, you're only working for 45% now. And you cannot get, there's no guarantee you can get the whole of 45%. So that limits you in passing this paper first time. So what am I saying in essence? I'm saying for you to pass advanced paper, advanced tax unit, you must have a balance. You must be able to answer very well theory and also answer computation. With this combination, it should not be a problem to pass this unit in the first setting. So from the word go, I want to establish that kind of mindset that you will balance both computational and theory, computational and theory. And that means you may not have much of a problem. Now, I will not go through the whole of your syllabus topics for obvious reasons. If you have assured me that you came to class with the syllabus topics, then I will discuss it. Otherwise, it will be pointless for me to discuss the syllabus topics, especially if you don't have it. So make a point of getting a syllabus. I would have shared the course outline, but I don't have what do you call it? My smartphone. I locked my smartphone just this week. So because I don't have a smartphone, I'm not even on WhatsApp. So I'm unable to do a number of things. But I hope I'll be able to get a smartphone at some point. So I'll be able to share some of that material. Now, having said that, our first topic is called taxation of partnership. Topic number 1 is taxation of partnership. I'll give a summary of what we'll cover in this topic, and then we'll be able to start. So the summary is the following. We'll cover the definition of partnership. This is according to the Partnership Act. Chapter 29 of the Partnership Act. Then we look at admission. Admission and return. Admission and retirement of partners will be our second aspect of coverage. Then we'll cover conversion. LLC, conversion of a partnership into a limited company, LLC. The last subtopic, we have only 4 subtopics in partnership, is called incomplete records. Incomplete records in partnerships. Now, those are the 4 areas of coverage, and we're done with that topic. So that our next topic, number 2, will be limited liability companies. It comes after partnership. But I hope, hopefully, when you have time, you can be able to look at the whole syllabus and see what's supposed to be covered. So I'll go right away into the first aspect of partnership, and I'll get the definition. Before I give you a formal definition, this one comes from the Partnership Act, Cap 29, Laws of Kenya. The definition is very important. Why is it important? It will tell us what a partnership is and what it is not. You know, so it says it defines a partnership as a relation. So it will define a partnership as a relation which subsists. So our partnership is not an entity, is not a business. It simply is merely a relation which subsists between persons. Persons, I'll give you this definition, but don't worry. Persons carrying on business in common. In common means there is shared interest. You contribute capital, you share responsibilities, you even share profits. So these aspects are very important. A partnership is not an entity legally. It's merely a relation which subsists between persons carrying on business in common. And this business in common has a motive. There's a speculative motive with a profit motive. They wish to make profits. So if you engage in any activity together with other people, but not for profit, then that would not be a partnership, according to our definition. Or if there are persons carrying on some activities, but it's not common. In other words, there's no contribution of capital, there's no sharing of responsibilities. Again, legally, that will not be a partnership, and so on. So let's give this definition, a formal definition, and say a partnership is defined by the Partnership Act. Act is capital A. A partnership is defined by the Partnership Act, A capital, by the Partnership Act, Cap 29, Laws of Kenya. A partnership is defined by the Partnership Act, Cap 29, Laws of Kenya, as open quote. We'll quote this definition because it's very important. Open quote. open quote, the relation which subsists between persons. The relation which subsists between persons. The relation which subsists between persons. The relation which subsists between persons, carrying on a business in common. Carrying on a business in common. Carrying on a business in common with the view of profit, end of quote. Carrying on a business in common with the view of profit, end of quote. End of quote. Then you add this statement and say, a partnership is not recognized. A partnership is not recognized as a legal entity. A partnership is not recognized as a legal entity that is distinct and separate. A partnership is not recognized as a legal entity that is distinct and separate from the partners. A partnership is not recognized as a legal entity that is distinct and separate from the partners. That is distinct and separate from the partners, comma, that is distinct and separate from the partners. Or you can even put a full stop. That is distinct and separate from the partners, full stop. Then the next point, it is formed with the motive of sharing profits. It is formed with the motive of sharing profits. It is formed with the motive of sharing profits. It is formed with the motive of sharing profits. Hence, the profit of the business. It is formed with the motive of sharing profits. Hence, the profit of the business. Hence, the profit of the business is deemed to be that of the partners. Is deemed to be that of the partners. Is deemed to be that of the partners. And is shared among them. And is shared among them in their profit. And is shared among them in their profit, or in brackets loss sharing ratio. And is shared among them in their profit, or in brackets loss sharing ratio. And is shared among them in their profit, or in brackets loss sharing ratio. So that statement or that definition will guide or will provide a lot of principles which you'll find useful as we move along. So we'll be coming back to that definition to explain what happens. For example, the last part of the definition said the reason why these partners are even going into this relation, which subsists among them as they carry out business in common, is for speculative reasons, is for profit. So, as accountants, we know that if it's for profit reasons, then accounts have to be prepared. A statement of income has to be made so that the partners know whether they have a profit or loss, or a profit or loss, because it's very important. They've said the reason why they are carrying on business in common is to make profit. Now, to make profit, we have to prepare a record. So our next discussion will look at the statement. Statement of partnership. Statement of partnership. Statement of partnership profit. So this business will prepare records. From those records, they will draw a statement of profit or loss. Now, it will be interesting it will be interesting to note that even though the partnership will have this statement prepared, it is not the same statement as the one required for tax purposes. It is important first that we know why it is not the same as that required for tax purposes, so that we can be able to understand the adjustments that follow. Because the examiner will require you to prepare a statement of adjusted profit or loss. So before we can even go there, we need to look at this statement and analyze it and know why would it be different from the statement required for tax purposes. Now, I will propose 4 reasons. Now, those 4 reasons will form the basis of our adjustment, will form the reasons why, or will inform the adjustments we make, so that this statement reflects the profit or loss required for tax purposes. So here are the reasons. Now, the first reason why this statement will not be the same as the one required for tax purposes is the expenditures or expense items. Expense items. So there are expense items which are accepted for accounting, from accounting point of view, in making this statement, but they may not be allowed for tax purposes. An example would be expenses or losses that involve assets. Losses like depreciation, amortization, impairment, including other expenses like general provision for bad debts. Taxes, any taxes, stamp duty, VAT, customs duty. Those taxes are not acceptable as expenses in preparing a statement for tax purposes. So we are saying, like, we will need to adjust. Why? Because in preparing the profit or loss for accounting purposes, there are expenses that have already been deducted, which are not allowed from tax point of view. So what is the adjustment? All these expenses will be added back to the reported profit in adjusting the profit for tax purposes. We'll add them back. Now, that is point 1. Point 2, we have items called capital expenditure. In arriving at the accounting profit, there are certain expenses that have been incurred, which are referred to as capital expenditure. For example, the business could have acquired a pickup and charged in the P&L account, or computers, or software. Okay, the business may also have acquired partitions, or furniture and fittings, or stuff like that, you know. Again, if capital expenditures have been charged in the income statement, they must be adjusted. So what is the adjustment? Add back all capital expenditures to the reported profit. Then you will do something else. We provide for investment allowances. So investment allowances will be given based on the applicable rates. So investment allowances will be deducted. You add back the cost of the asset. For example, if you purchased computers, you'll add back the cost of computers, then you're allowed to claim computer and software allowance at the rate of 25% of the expenditure incurred. In case there are partitions included in the income statement, then we'll add back the partitions and claim an allowance of 10% for the partitions. These are standard rates. You'll find them at the top of your past paper question. So if you download any exam question, you're going to find those allowances, the rates are given there. So that's the second point of difference. Any capital expenditure that appears in the income statement will be disallowed. So how do you correct or how do you adjust? Add them back to the income statement, then later provide for an allowance. You can deduct an allowance based on the rates. 10% for partitions, 25% for computers and software, 50% for machinery, and so on. Then there is another difference. This one we will call specified sources of income. So turn this page a little bit. And you have something called specified sources of income. So we'll call this one A, this one B, now this is C. Specified.
I love your massage.
Thank you.
So somebody has not muted themselves. So we have specified sources of income. So what are these? So specified sources of income are, you have to identify where the income is coming from. I'll give you a few examples. Employment is a source, employment. We have another source called farming. We have rental income. We have business. Business could be trading, could be manufacturing, we have investment income. So the statements that have been prepared for accounting purposes, the accountant does not categorize income. But for tax, it's important because we have provisions, we have rules which deal with these incomes very different. For example, employment income is taxable under the PE rules or graduated scale rates, very different. Farming income is a separate source because it has its own rules. Rental income, there are two types of rental income. You have residential property. I'm sure you understand residential property that is rented for purposes of, say, living. You stay there, residential property as residents. Then you have commercial property. For residential property, we'll be looking at the rules. You don't have to prepare a statement. You pay to carry 7.5% of the gross rent, as long as your rent is up to 15 million shillings per annum, then you qualify for that treatment. The system is called monthly rental income tax regime, MRI, for residential rental income. Then there's commercial property. Commercial property is when you rent buildings for offices, for warehouses, and that's commercial property. Or godowns. So for commercial property, you have to prepare a statement. The system is called standard rental income tax regime, we prepare a statement, gross rent less allowable expenses, then you pay tax on the net. So all these incomes have specific provisions on treatment, so you cannot put them in one statement because the treatment is different. For example, for business, trading, you need a statement. For manufacturing, you need a statement. Investment income could be dividends or could be interest income. Okay? For interest, there's withholding tax of 15% at source. For dividend income, there's withholding tax of 5% and so on. So what am I saying in essence? Each of these sources have to be separated so that you can calculate each source separately. Then the rule requires if any source has a profit, you will add together. If there's profit, you will add together. But should any of these laws derive a loss, then the loss must be carried forward. That's what the rule states. You carry forward, you can only offset against the profits of the same source. For example, if farming had a loss, I will carry forward that loss and offset against profits from farming, the same source, next year or in future years. Same to rental and so on. So what is the adjustment of specified sources of income? I'm required to deduct them so that they can be calculated separately. Deduct them from the statement. Then there's a last point of difference, B. These are non-taxable incomes. So the accountant does not know, okay, he is doing the profit for different purposes, not for tax. So it's not about knowledge. He's preparing a statement for the partnership, not necessarily for tax. So that he'll have included every source of income he knows. But there are some that have been put there that are not subject to tax. I'll give you examples. Examples would be unrealized. Foreign exchange. Unrealized foreign exchange gains are not taxable. What is the difference? If they are unrealized, it means the accountant has already recognized a gain, but the gain has not been received. You've recognized because the exchange rate is now favorable, but since the transaction has not yet been finalized, the gain is not yet in our account. We've not received it because the transaction has not been done. But the exchange rate is favorable in the books, in theory, but we've not received it. Tax does not, is not claimed on any income that has not been received. You have to receive it first. So this is non-taxable. So the correction would be to remove it from the income statement. Another one would be income from foreign investments. So you can have invested in foreign countries. So you can have invested in Uganda Stock Exchange or Tanzania Stock Exchange or South Africa Stock Exchange, and you receive interest or dividend income or London Stock Exchange. It will not be taxed in Kenya because the laws of Kenya only applies within Kenya. So if the examiner tells you this is dividend from foreign investments, you have to deduct it. Then you have something like interest on drawings. So in partnership, you have an item like this, interest on drawings. Now, interest on drawings is what they've agreed to charge from cash drawings. If you pick cash drawings, you'll be charged interest. But that's not part of trading. So it's not part of trading income. So again, this one is deducted and so on. So we will discuss those results. Then we will prepare a statement now adjusted for these purposes. We'll adjust the profit for accounting purposes. We'll make adjustments for this. But first, we can put down this. So it says statement of reported profit. Sorry, the statement of partnership profit or loss. Statement of partnership profit or loss. Yeah? Then you say the reported profit for accounting. The reported profit for accounting purposes. The reported profit for accounting purposes is different. The reported profit for accounting purposes is different from the profit that is required. The reported profit for accounting purposes is different from the profit that is required for tax purposes. From the profit that is required for tax purposes. And you say, the main reasons for the difference include the following. The main reasons for the difference include the following. The main reasons for the difference include the following. A, expense items, expense items, expense items, expense items. Then you say certain items of expenditure. Certain items of expenditure which were deducted. Certain items of expenditure which were deducted for accounting purposes. Certain items of expenditure which were deducted for accounting purposes, may not be allowable expenses, may not be allowable expenses for tax purposes, may not be allowable expenses for tax purposes, e.g., depreciation, impairment loss, write-off of an asset, general provisions for bad debts, general provisions for bad debts, stamp duty and any other taxes, stamp duty and any other taxes, stamp duty and any other taxes. The new sentence is saying, disallowable expenses are added back to the reported profit. Disallowable expenses are added back to the reported profit. Disallowable expenses are added back to the reported profit in adjusting the profit. Disallowable expenses are added back to the reported profit in adjusting the profit for tax purposes. In adjusting the profit for tax purposes. In adjusting the profit for tax purposes. That is A. That is expense items. Then you go to B. Let's put specified sources of income. Specified sources of income. Specified sources of income. Specified sources of income. Then you say the reported profit for accounting purposes. The reported profit for accounting purposes. The reported profit for accounting purposes may include income from various sources. May include income from various sources. May include income from various sources. However, for tax purposes, income must be calculated separately. However, for tax purposes, income must be calculated separately according to the specified sources of income. Income must be calculated separately according to the specified sources of income. Then you say, however, for tax purposes, income must be calculated separately according to the specified sources of income, whereby any losses generated from a particular source, must be carried forward. Whereby any losses generated from a particular source must be carried forward to be offset. Against the same. To be offset against profits. To be offset against profits from the same source. To be offset against profits from the same source in the future years. To be offset against profits from the same source in the future years. Then how do we adjust for them? You add this sentence and say, specified sources of income are usually deducted from the reported profit. Specified sources of income are usually deducted from the reported profit and computed separately for tax purposes. Okay, then C, capital expenditure. Capital expenditure is C, capital expenditure. Then you say, capital expenditure items may have been deducted. Capital expenditure items may have been deducted in determining the reported profit. Capital expenditure items may have been deducted in determining the reported profit for tax. Okay, in determining the reported profit for accounting purposes. Capital expenditure items may have been deducted in determining the reported profit for accounting purposes. So you say, in adjusting the reported profit, Capital expenditure is added back. Capital expenditure is added back. Capital expenditure is added back, e.g., cost of furniture, e.g., cost of furniture, e.g., cost of furniture, partitions, cost of furniture, partitions, signboard, computers, motor vehicles, machinery, etc. Machinery, etc. In addition, for tax purposes, investment allowances are granted. Investment allowances are granted on the capital expenditure incurred. In addition, investment allowances are granted on the capital expenditure incurred, to acquire assets. E.g., motor vehicle allowance is granted. Motor vehicle allowance is granted at the rate of 25%. Motor vehicle allowance is granted at the rate of 25%. At the rate of 25% on a straight line basis. On a straight line basis, on the capital expenditure incurred. On a straight line basis, on the capital expenditure incurred. Then lastly, D, non-taxable income or non-taxable incomes. Non-taxable incomes. Non-taxable incomes. Non-taxable incomes. And you see the reported profit for accounting purposes. The reported profit for accounting purposes may include non-taxable income. The reported profit for accounting purposes may include non-taxable income. Such as unrealized foreign exchange gains, unrealized foreign exchange gains, profit from foreign investments, profits or income from foreign investments, income from foreign investments, or interest on drawings, Then you say, in adjusting the profit for tax purposes, non-taxable incomes are deducted. Non-taxable incomes are deducted. Non-taxable incomes are deducted. Okay, very well. Now that we have discussed the reasons why the two statements are different, now we can go ahead and prepare a statement of adjusted profit or loss based on those principles we've talked about. So let's prepare this statement. So the statement that is required for tax purposes. So we'll have a statement of adjustment. So you say the profit reported for accounting purposes can be adjusted. The profit reported for accounting purposes can be adjusted. The profit reported for accounting purposes can be adjusted to determine the profit required for tax purposes can be adjusted to determine the profit required for tax purposes as follows. Can be adjusted to determine the profit required for tax purposes as follows. Can be adjusted to determine the profit required for tax purposes as follows. Let's prepare this statement. This is how we adjust that. We'll have two columns for adjustment. Then you say the reported profit. If that is excess, this is just a format, then you say add back. So in our discussion, there are things we will say we will add back. And the first one was A, items of expenditure which are not allowed, like depreciation, impairment, write-off of assets, taxes, general provision of bad debts. All those items will be together called disallowed expenses. And we add them back. We also said there was an item C, which you call capital expenditure. We said in the statement, you may come across partitions, computers, machinery purchased, pickup, signboard, billboard. So any capital expenditure you find in the income statement will have to be added back here. So we say also capital expenditure. This total I put on the extreme right column, I put the total. Then there'll be items of deduction. So you must remember, we said item B, specified sources of income. You have to separate sources. So we say here, specified sources. Deducted. We'll also deduct item D, non-taxable incomes. So non-taxable incomes. Then we said, after you've added back capital expenditure items, you'll be allowed to claim investment allowances, like 25% on your pickup, 25% on your computers, and so on. So also deduct investment allowances. What you get here is what you call adjusted. Also could be a loss, it could be a profit or a loss. Now, this is the profit or loss for tax purposes, but we are not there yet. The reason we are not there, I'll take you back to our definition early in the lesson under the Partnership Act, Cap 29. We said this is simply a relation. It's not an entity. So you can't tax it because legally it's not an entity. Maybe for accounting, it's a business, but legally it's not an entity. So there is no tax on the business because the business is not there legally, it doesn't exist. So what happens? What happens is that this has to be shared among the partners in their profit or loss sharing ratio. And for us to do that, you have to prepare another statement. So usually the examiner will ask for two statements. This first one, the statement of adjusted profit or loss, you get it for tax purposes. Then he'll ask you for a distribution schedule. In that schedule, you share this profit to the partners. Because partners are natural persons, each individual will bear their own burden of tax. So indeed, they'll be taxed using the graduated scale rates because they're individuals. So next, we look at this other statement called distribution. Or allocation. Schedule. Distribution or allocation schedule. And you say the partnership is not recognized. The partnership is not recognized as a legal entity. The partnership is not recognized as a legal entity that is distinct and separate. The partnership is not recognized as a legal entity that is distinct and separate from the partners. As a legal entity that is distinct and separate from the partners. Hence, the profits of the partnership. Hence, the profit for the partnership adjusted for tax purposes. Hence, the profit of the partnership adjusted for tax purposes is distributed. Hence, the profit of the partnership adjusted for tax purposes is distributed among the partners. Is distributed among the partners in their profit, is distributed among their partners in their profit, or in brackets, loss sharing ratio. Is distributed to the partners in their profit or in brackets, loss sharing ratio as follows. So just for our purposes here, we will assume there are two partners. And here we have partner A and B. So we have partner A, we have partner B, and you must always have a column called that. So you'll distribute or you'll allocate anything they have been paid or what they have received, like interest on capital, interest on their capital contribution, so A, B, total. Like salaries, probably A was not paid because he did not run the business, it's just B, book salaries. Or commission. Maybe A got commission. Or maybe you have interest on drawings. So interest on drawings will be a cost on them. So it will be used to reduce whatever share they have received. So from their share, reduced by interest on drawings. We remove interest on drawings and we remove the total. Then you can look for share of profit or loss. You bring the same adjusted down here. Adjusted partnership profit is what we're using. And the total column. So you take your calculator and put this, you input the adjusted profit. Then you subtract what was paid as interest in capital. So you minus that. You minus what was paid as salaries. You minus what was paid as commission. But you add interest on drawings because the partners are supposed to pay the business. So you add that. The result of what remains you put here. And I should have put the profit sharing ratio. Let's assume it is half. They share profits and losses, half, then. So you get half of this for A, half for B. Like that. Then you get the subtotals. I will add this plus this minus this plus this. This plus this minus this plus this. If your distribution was correct, if you add this and this, you should get this. You should reconcile. This and this should give you that total. So what you have distributed to the partners is trading income, one source. The other sources you are deducted, you can now share here. For example, suppose the partners have commercial property, rent, because if it is residential property, I've told you there's a system called monthly rental income tax regime. You pay 7.5% of the gross rent. But if it's commercial property, you subtract expenses, then you bring it here. You say rent. Assume it is commercial property. A gets his share, B gets his share. The other item, they could be having dividends from farmers. Farmers cooperatives. Farmers cooperatives at the grassroots. like tea growers, coffee growers, dairy milk producers, and so on. So say here, dividend from farmers. This is dividend from farmers for all. And it must be gross. A gets his share, B gets his share, and they could also be having farming income. These are other sources. A gets his share, B gets his share. Then you get their totals. This is called total taxable income. That is what you will tax using the graduated scale rates. So if the examiner asks for tax, then you take that total income. A will be taxed separately. Unachukua ya A, that's XX, use the graduated scale to tax it. B, like that. Do we have any questions so far? Any question? Anyone? Very well. So what we've done so far is general partnership. And if you check the list of the summary I've given, there are specifics now to be covered. Now I want us to cover admission and retirement of a partner. So we'll do that, then we are ready to tackle an exam past paper question. So the next segment, we look at admission or retirement. So next we're going to look for admission. So when a partner is admitted or retired, it requires adjustments in any of these two statements. The profit and loss account, to be specific, not the trading account, the profit and loss account and the distribution schedule, depending on the information given. Now, there can only be two alternatives. Alternative A, if the examiner says all profits and losses or all revenues and expenses accrued evenly or equally throughout the year. So revenues and expenses accrued evenly throughout the year. If that is the case, then you will not adjust the profit and loss account, the income statement. You will not adjust that. The adjustment will come in the distribution, and you'll apportion the allocations like interest on capital, salaries will be apportioned depending on the dates. For example, if a partner is admitted in July, Then you'll have each of those items apportioned between January and June when the partners are on their own, A and B, before C is admitted in July. So you'll have interest on capital January to June, interest on capital July to December. You'll have the same salaries like that. The idea is so that you can get the profit from January to June and share between A and B. And you can get the exact profit from July to December and share between A, B, and C. So if revenues and expenses accrued evenly throughout the year, the adjustment for admission or retirement will only happen in the distribution, only in the distribution. Then you'll be able to complete nicely. There could be another case, B, where revenues and expenses did not accrue evenly. A common example, they can tell you that the business purchased assets in July, immediately after admission of C. Then it means the profits and losses will not accrue evenly because there is an expense called investment allowance on the assets, which you must charge directly in the period when the assets were acquired, from July to December. So if revenues and expenses did not accrue evenly, you will split the P&L and you also apportion the distribution schedule. Those are the only two scenarios. In the first scenario, you only do apportionment in the distribution schedule. In the second scenario, you do an apportionment in the profit and loss account and also in the distribution. So let's write something about that and we are done. So admission stroke retirement of partners. So we say adjustments must be carried out. Adjustments must be carried out. Adjustments must be carried out in the income statement and distribution schedule. Adjustments must be carried out in the income statement and the distribution schedule to take account of admission, to take account of admission or retirement of partners, or to take into account admission or retirement of partners, to take into account the admission or retirement of partners. Then you say the two possible cases that require adjustment include the two possible cases that require adjustment include A, where revenues and expenses accrued evenly. Where revenues and expenses accrued evenly, where revenues and expenses accrued evenly throughout the year. Where revenues and expenses accrued evenly throughout the year. The revenues and expenses accrued evenly throughout the year. Then we say In this case, adjustment for retirement or admission of a partner, in this case, adjustment for retirement or admission of partner will be completed only in the distribution schedule. Will be completed only in the distribution schedule. Will be completed only in the distribution schedule. All the allocations to partners, will be apportioned. All the allocations to partners will be apportioned for the periods before and after. For the periods before and after admission or retirement. All the allocations to the partners will be apportioned. All the allocations to the partners will be apportioned for the period before and after. All the allocations to the partners will be apportioned for the periods before and after retirement or admission of partner. Then B, you say, where revenues and expenses did not accrue evenly. Where revenues and expenses did not accrue evenly. Where revenues and expenses did not accrue evenly throughout the year. Where revenues and expenses did not accrue evenly throughout the year. E.g., in case assets of the business, in case assets of the business are purchased immediately. In case assets of the business are purchased immediately after retirement or admission of a partner. Are purchased immediately after retirement or admission of a partner. Immediately after retirement or admission of a partner. When you say, in this case, both the profit and loss account, in this case, both the profit and loss account and the distribution schedule, in this case, both the profit and loss account and the distribution schedule will be adjusted. Will be adjusted for the admission or retirement. Will be adjusted for the admission or retirement. Will be adjusted for the admission or retirement of the partner. So that completes the first segment of our discussion. The first question we look at, and I know there'll be a bit of a challenge to get this question, but I'll see. The challenge I'm talking about is I don't have my smartphone. Otherwise, I would have forwarded. So I'll find out if what I had used last semester, if they had not erased, I'll ask somebody to forward it to you. Yeah? So the question should be December 2014. December 2014, question 1 is called Big Enterprises. BD Enterprises. BD Enterprises is a question on admission. This will be a question on admission. Then I'll give you as an assignment, December 2022. Question 3A is called A, B, and C partnership. This one you can get, you can download, and this one will be on retirement. Again, it's a case of retirement where the revenues and expenses did not accrue equally. It's a case of B. This is a case of B. Revenues and expenses did not accrue because they are assets that are purchased on retirement of C. When C retires, I think somewhere in September, then they buy assets. So you'll adjust both the P&L and the distribution schedule. This one is for admission, but it's for case A. Revenues and expenses are accrued equally. So the adjustment for the admission will only be done on the distribution schedule. Let me check if the question I had sent last semester is still available so that I can forward to you this one. Otherwise, it will be a bit of a challenge. Alternatively, I could start with this other question because this one you can get. And then probably later, I don't know how, but we'll see if we can get hold of this because I only have a soft copy. Or alternatively, I think there are many ways to kill a rat. We can have it, I can have somebody make a photo and share with you. I think that would be another alternative. That would help, eh? Let me see if I can have this photographed. Then you're sent a copy for December 2014. Yes. Let me do that. Then this other one, you also try as an assignment. So love quick questions. Let me look for December 2014. Then I'll have somebody get a photo of this and share with you. I hope they have a good camera because this one doesn't appear very nice. Let me just arrange that right away. Just give me a few minutes. Just give me a few minutes to arrange that. So I've arranged for the copy to be sent to you. So let me know as soon as you have it. I'll answer part A. It has A and B. A is theory. Theory is important at this level. I've already explained to you earlier. So I'll start by answering part A. So what you've received is December 2014, question 1. So A says this, explain the meaning of tax planning. I hope you've received it. Mmepata ama bado? Please confirm if you've already received the copy. Bado. Somebody will share it. Saizi tu. It will be shared saizi too. Then I'll be able to look at part A. So I hope it has arrived by now. I hope it has arrived because I left him sending. So it says, explain the meaning of the term tax planning. The meaning of the term tax planning. So to be able to understand and explain, it's not complete. Okay, it's a wide page. Look at the first part, the initial one, written question 1 hapo juu. Kuna some small part on the left. Then there is another part on the right. I think it's complete. It's supposed to be 2 sides. So hiyo part side unaona kuna computations, kuna numbers, kuna theory at the bottom of the page. On the extreme, sijui what side of your paper, but mine is on extreme left. At the bottom, kuna theory. Then computation is on the right. I think it's complete. So that part, you've seen it, but not clear. Now that's the best we can do. Actually, had assured me that his phone is very, very clear. I would have sent you a better soft copy, but I don't have my smartphone. I lost it earlier this week, so it's poorly for that. So just struggle. So that part has this theory. Nasema A, explain the meaning of the term tax planning. Explain the meaning of the term tax planning. And Roman 2, outline 4 reasons why enterprises engage in tax planning. So let me answer that. So let's answer that. Okay. So to be able to answer that question, to be able to answer that question at your level, we will distinguish between three very related terms, very closely related terms. So you have your tax planning, your tax avoidance, and your tax evasion. So I'll explain each one of them to distinguish them. For example, tax planning is where a business or a taxpayer arranges the affairs of the business in such a way as to reduce their tax liability or burden, but this will be done within the law. You don't break any law. Without contravening any tax law or tax legislation. So every decision the business wants to make, they will weigh the options on the impact of tax on the decision they make. For example, Safaricom is required, the central bank wants Safaricom to separate the business of M-Pesa from the other Safaricom business. It has already been agreed. Actually, Airtel has already done that. But Safaricom, because of tax planning, they know immediately they do the separation, there'll be a tax obligation. There's immediately an amount, I think capital gains, KRA would want, and it's a lot of money. It's close to 1 billion shillings. So Safaricom is still negotiating if they can get away out of that, so that they get away with payment of that tax. That's why there has been delay in segregation or separating the two businesses. Otherwise, it's a foregone conclusion. It has already been agreed. M-Pesa will be a different company from the other businesses. But what now Safaricom is looking for is a way to break the businesses without very grave tax implications. Because if they just separate, immediately there's a tax obligation from KRA. I think it's capital gains, and it's a lot of money, So that would be tax planning. How about tax avoidance? Tax avoidance is also reduction of, say, your burden, but it's different from tax planning, because in tax avoidance, you take advantage of a law or a loophole. It means the commissioner can easily reverse that transaction by bringing what we call an anti-avoidance provision. So in tax avoidance, you're still trying to reduce your burden or avoid tax, but you are taking advantage unduly of a law. Let me give you an example. We know that interest expense on borrowing on a debt is a large expense. But then you may want to take advantage by bringing excess debt, especially for foreign companies. They may want to overburden their branch here or their subsidiary by excessive debt deliberately or intentionally, so that the interest expense is large enough to reduce their profit. Now, if that happens, there is a law that will take care of that. It's called an anti-avoidance provision. The provision there is called 30% of EBITDA. So if a foreign company or a non-resident company wants to use tax avoidance to have excessive borrowings or excessive debt on their branch, and they usually like borrowing in dollars or euros to reduce their taxable income, the commissioner can exercise this law. It can invoke this provision, 30% of EBITDA. EBITDA means earnings before interest, tax, depreciation, or amortizations. Earnings before anything. The maximum interest you can ever get is 30%. Any interest above this 30% is treated as excessive. It will not be allowed. That's an example of avoidance. Another example of avoidance is where in a family business, you employ directors who are relatives, like the wife, the husband, the child, the daughter. Then they pay them excessive salaries with the plan that it will be charged in the P&L to reduce their income. That is avoidance. Or where assets of the business are disposed, but at lower prices. You want to sell products of the business, but at lower prices to understate income. That is avoidance, because you're pretending to do what is legal because you're using the law, but you are taking undue advantage of a loophole within the tax law. So that loophole, you may not survive. The commissioner may have a way to block that. And if he blocks, you'll be charged penalties. So the penalty, if an anti-avoidance provision is invoked by the commissioner, the penalty is very severe. I think you pay double what you could have avoided had that gone through. If it could have been successful, the amount would have escaped as tax. You pay down. Then evasion is now outrightly illegal. Is where you want to reduce your burden but illegally. You don't file returns, you submit understated profit or understated income, or you submit fraudulent statements. So the statement you prepare with excessive expenses so that you report nil profits or negative profits and so on. That would be evasion. Now let me explain to you so that you can write. So we'll explain each one of them. Let's start with tax planning. So what is tax planning? What is tax planning? So you say, this is the arrangement. This is the arrangement of the affairs of a taxpayer. This is the arrangement of the affairs of a taxpayer. This is the arrangement of the affairs of a taxpayer in such a way. This is the arrangement of the affairs of a taxpayer in such a way as to reduce their tax burden or liability, in such a way as to reduce their tax burden or liability without contravening. Without contravening. Without contravening any tax law. Without contravening any tax law or legislation. Without contravening any tax law or legislation, e.g., use of debts as a source of capital for the business, e.g., use of debt as a source of capital for the business, use of debt as a source of capital for the business, in order to claim interest, in order to claim interest as allowable expense, in order to claim interest on debt as a allowable expense. In order to claim interest on debt as allowable expense. Then let's go to tax avoidance. Tax avoidance. Then you say the Tax Procedures Act of 2015. Act, make sure it's capital A. The Tax Procedures Act of 2015 defines the term tax avoidance. The Tax Procedures Act 2015 defines the term tax avoidance as, open quote, we'll quote this, as a transaction or a scheme. A transaction or a scheme designed. A transaction or a scheme designed to avoid liability. A transaction or a scheme designed to avoid liability to pay tax. A transaction or a scheme designed to avoid liability to pay tax under any tax law. End of quote. Under any tax law. End of quote. Undertaking any tax law. End of quote. Then you continue and say, it involves taking advantage. It involves taking advantage of the loopholes. It involves taking advantage of the loopholes. It involves taking advantage of the loopholes in the tax legislation, of the loopholes in the tax legislation to reduce the tax burden or liability. To reduce the tax burden or liability. To reduce the tax burden or liability. Then we look at tax evasion. Tax evasion. Tax evasion, we say, this is the arrangement by a taxpayer. This is an arrangement by the taxpayer. This is an arrangement by the taxpayer to reduce their tax burden or liability. This is an arrangement by the taxpayer to reduce their tax burden or liability using illegal ways. Using illegal ways or means. Using illegal ways or means. E.g., using illegal ways or means. E.g., we can give examples. Failure to file returns. Failure to file returns of income. Failure to file returns of income. Failure to file returns of income. Next, under declaration. Under declaration of income. Under declaration of income. Another example, making false claims. Making false claims of VAT or income tax refunds. Making false claims of VAT or income tax refunds. Making false claims of VAT or income tax refunds. Then you look at Roman 2, they're asking this. Outline 4 reasons why enterprises engage in tax planning. 4 reasons why enterprises engage in tax planning. So you say, enterprises engage in tax planning for the following reasons. Enterprises engage in tax planning for the following reasons. Enterprises engage in tax planning for the following reasons. The first bullet, easing tax administration. To easing tax administration, to easing tax administration in terms of the methods used. To easing tax administration in terms of the methods used in accounting for tax. To easing tax administration in terms of the methods used in accounting for tax. To easing tax administration in terms of the methods used in accounting for tax. You continue the same sentence. Records to be maintained. Records to be maintained to easing tax administration in terms of the methods used in accounting for tax. Records to be maintained. Records to be maintained, and the tax reports. And the tax reports to be prepared. And the tax reports to be prepared. And the tax reports to be prepared. The next one, achieve the highest level of compliance. Achieve the highest level of compliance with tax regulations. Achieve the highest level of compliance with tax regulations. Achieve the highest level of compliance with tax legislation. And I'm sure you know the benefits of being in compliance. You're not afraid that you'll be interrupted, your business will be interrupted, or that KRA will take you to court, there'll be prosecution. That's the beauty of compliance. So everybody wants to be in compliance so that you don't go through those inconveniences, that your business is not interrupted, or your accounts are not freezed because KRA has those powers, or your business is not shut down, stuff like that, right? So the advantages in achieving highest level of compliance with tax regulations. Another reason, reduce the impact of the tax burden. 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 Then final reasons, to defer the impact of direct and indirect taxation, to defer the impact of direct and indirect taxation on the business. To defer the impact of direct and indirect taxation on the business. So I think that's all the time we have. Unless you have a question, you can ask. We're left with some 3 minutes. So it means you have to do the B part as an assignment, but we look at it in the next class. And you also have to look at December 2022, question 3A. You know, it's the same. It's on retirement, right? So do we have any question? Any question? Any question? So I think from the timetable, our class should be a day like this. I think Sunday, Sunday is 4 to 6. The other class is on Saturday. Saturday is 7 to 9. Saturday is 7 to 9. Sunday is 4 to 6. So that those are our 2 sessions for this unit. So if there are no further questions, then I think we will stop there. So thank you for coming. Have yourselves a wonderful weekend. So we'll be able to continue from that point. Asanteni sana.